What's going on, everybody? Welcome back to the Loan Lads. We've discussed fix and flips and bridge loans. We've also discussed the basics of hard money lending. But what if you want to build something from the ground up? That's today's topic, ground up construction financing.
Park Place Finance, a nationwide hard money lender offering fix and flip, ground up construction and DSCR loans. Check us out at parkplacefinance.com.
All right, so let's go ahead and just chat about what a ground up construction loan is for those out there who maybe don't understand it.
Absolutely. So ground up construction loan is pretty self-explanatory. You're going from the ground up. So it's a loan or a real estate investment strategy to where you are actually building from the ground up. So you're building a new home, maybe spec, it may be a custom home, right? But that is basically where you have the land and then you are building from the ground up to either sell or refinance the property once it's actually been completed.
Yeah, and they're typically short-term loans, so they're typically anywhere from 12 to 24-month terms. Yep. Depends on the market, depends if it's a purchase, refinance, and kind of the permit process as a whole.
Yeah, so those loans are really there to cover the build time, time of marketing and time of selling of these properties. A lot of lenders see that if the project is a bigger project, maybe a bigger square footage property, they will give them a longer term loan, maybe an 18 to 24 month term loan, to cover the ground up construction piece, the marketing piece, and then the exit strategy piece.
Yeah, so what does the ground up construction loan cover? That's one thing we definitely want to touch on, which is typically the cost of the land itself on a purchase sometimes, and then 100% of the construction costs. Yep. Depending on the loan to cost, which is kind of what we're looking at, which is basically what the property was purchased for, if it's being purchased, or maybe it's already been purchased in cash, and then what the actual budget itself is, right? So the construction cost of the project.
Right. Yeah, absolutely. And those are the main two things that we look at, right? Typically for a new borrower, you're looking at around 80 loan to cost. And then for your more experienced borrowers that maybe have done 3+ in the past 3 years, they'll be looking at closer to the 90% LTC mark there, which stands for loan to cost. Yeah,
so these construction funds are typically released in draws. And what is a draw? I know we've touched on draws a couple times in our past and previous episodes, but a draw on the construction side is a little bit different because it goes in phases, right? So typically you're going to have your soft cost, you're going to have your foundation that obviously has to be poured first, and then you're going to go all the way through framing, rough in, rough out, and finishes. So on draws with a construction loan, typically we're going to reimburse that based on percentage of line items complete. So we'll go in and reimburse a percentage of the soft cost spent to date. Typically that's going to be your permits, your planning, your architectural plans, surveys. It could even include like temp utilities, right? Things like that nature. And then also you're going to have your foundation, which is going to be really step one of the actual work being completed. Right. So what we're not going to do is give you those funds up front before the work's done, right? Because then we're giving more funds towards the dirt, which is what we're trying to stay away from. We want to actually reimburse based on the project being completed in a sense.
Correct, yeah. And as a new investor out there, understanding how the draw process works and understanding how your lender actually deals with the draw process is super important to having a smooth cash flowing project to where you can continually move through each phase of your project efficiently, effectively, and in the time frame that you're looking to actually get it completed. Now, the question I get all the time is, well, I've got this loan, but now I have to go spend my money first, right? Absolutely, yeah. So as a lender, the reason why we reimburse construction funds on draws is because we need to make sure that the funds that we are lending are truly going into our subject property that we've underwritten to, that we're actually lending the funds on, right? So, if we were to give funds up front in the form of cash, that we really don't know where those funds are going to. Technically, our investor could go to Vegas, put it on black and see if they can turn the luck and double the money there, right? Obviously, that's just a bit of a joke, but that's the way that a lender looks at it, to make sure that the funds provided for the loan are truly going into our subject property.
Yeah, absolutely. And these loans specifically are built for your custom home builders, your spec builders, developers, and then even investors who are building up a build to rent or maybe a rental portfolio itself, or maybe they're just building up a portfolio of homes to sell, right? That's typically who the main user, end user of this loan product is. But you also have sometimes first-time builders, right? Maybe they just obtained their GC license and they're trying to get some builds under the belt so that they can go start building for other people. And that's what we see often in this market.
Yeah, absolutely. There's a whole bunch of people that can capitalize from using a ground-up construction loan, just like people that are using the fix and flip loans, right? It allows borrowers, clients, the developers to spread their capital across multiple projects, which in our industry I like to call scale. Our funding allows people to go and scale their business, whether it is in fix and flip or maybe the ground up construction. Without funds, maybe they're doing a small development project without actually utilizing hard money ground up construction capital that we do offer. Maybe in that small development, they'd have enough cash to maybe do only 2 at a time, right? Compared to if they're using our financing, you could potentially do 5, 10, 15, 20 at a time, which keeps your cost per property down because you're doing more construction in bulk across your materials, across your labor, all that good stuff really helps to become more cost effective, as well as getting more done at one time in a quicker cadence of building to where you can then go and actually sell those properties and finish that small development much quicker.
Yeah, it allows you to not get stalled out at the end of the day, and that's the worst possible outcome on ground up construction is getting stalled out. Why is that? It's because build costs in today's market are going up, right? We see it month over month. What it costs for framing is not what it cost for framing a year ago today. What fixtures cost today is not what fixtures cost 6 months ago. So the cost of capital and the cost of material is consistently going up in this market currently. So getting stalled out is really the worst thing that could happen to a builder, right? And so what we're trying to do with this financing is move quickly. So these draws are designed for a builder to get in, get the work done, get reimbursed efficiently. Typically these reimbursements happen anywhere between 24 to 48 hours from the time a draw is submitted. So it allows the builder to continue moving through the project, basically progressing over time. For
sure. I think we should touch on how we're able to get those draws out in 24 to 48 hours. There's different ways that draws can be done. I'm mainly talking about the inspection piece of it. Can you give us a bit of background on the different ways that you've seen inspections take place, and then kind of loop in our sponsor Park Place Finance here and tell them?
Yeah, so typically in the market, what we're seeing is there's a lot of different ways to do draws. Some lenders do draws in-house, right? They'll just send an account executive or a loan officer, or maybe an in-house construction manager out to a property. Those are typically your companies who are local to a market.
For sure.
Your lenders who are nationwide, they typically use third-party companies, right? So that could be an in-person inspector, it could be an online inspector. And once you submit that draw, the inspector is going out to take pictures and videos of the work done, right? And what that allows the lender to do is look at the budget that you provided at closing that they have on file for your draw schedule, and then look at the work completed and understand what work's been completed, what cost has been spent to date, and what you need to be reimbursed for, right? And anybody in the industry, draws typically can take anywhere from 1 day to, 10 days, right?
Yeah.
It depends on who you're using and who you ask. For Park Place Finance specifically, we have transitioned into a third-party app, and what that app does is we try to make it as efficient and smooth as possible for these builders. What it does is you actually get a login, right? So you have, either the builder can log in, the borrower themselves has a login. It depends who they give access to the app for, right? And what that does is they'll go into the project themselves and take pictures and videos of the work completed, and then actually submit it in the portal. The portal automatically has an online inspector on the back end looking at the photos of the work completed, and they're looking at the budget provided at closing. They're going to tell us what you should be reimbursed for, and then us as the lender, we have an in-house servicing team. We're going to look at that. We're going to verify that the report's accurate. We're going to verify that the reimbursement's accurate, and then we're going to reimburse you. That all typically happens within 24 to 48 hours. I think right now we're averaging anywhere from like 42 to 43 hours on a turn time for a reimbursement, which is phenomenal, right? Waiting 2 days for a reimbursement on whether it's $15,000 or $100,000 is very quick. because that now allows you as the builder to go pay the contractor
Yeah.
right away, sometimes even before they've sent you an invoice, and then you can now move on to the next step in the project.
Yeah, that's that's extremely helpful. I mean, we did used to do the actual true inspector goes out to the property. Me, from the feedback that my clients are giving me, the turn time of getting draws back into the client's pocket has gone down significantly, just due to the fact that scheduling for an in-person inspector does not need to happen anymore.
Yep.
It really takes out the human side of it, to where, you know, stuff happens, people get sick, people may be on vacation. That happens on a day-to-day basis, right?
Yeah.
So the use of the app, to where really the investor has full control over how that draw schedule goes, and how efficiently they're getting those draws back and when they want to take draws, just really empowers them to be the full owner of the project, right? And not be constrained by the lender or maybe the time frame or somebody else's schedule, to kind of work around that. So I think it's really important that when you are speaking to a lender, whether it be Park Place or a different lender, you got to really ask about how the draws work, how the draw schedule works, and how to actually get reimbursed, right?
Yeah, and why is that, right? I think the big thing that everybody needs to understand is speed, right? Everybody needs to move as fast as possible in any of these construction type of loans. So that third-party app actually allows us to move much faster. Kind of like you said, the efficiency side of it is really what's going for these builders. It's what allows them to progress and proceed much faster throughout the projects and get them done quickly.
For sure. So I always get asked this question. Do you reimburse based on paid invoices, paid receipts, or if not, how do you reimburse? Can you kind of touch on that a little bit?
Yeah,
because there's definitely a preconceived idea of
how that
works.
We'll always look at invoices and paid receipts, right? We're never going to tell somebody not to, especially on the soft costs, right? For soft costs, we're going to want to see the paid invoices and the receipts. But for the work spent, we'll take the invoices. You can actually take pictures of those invoices and submit them through our third-party app, but we don't require it. And here's why. We do our due diligence up front, so we're going to do feasibility studies and budget reviews right on your budget to understand and make sure that the foundation cost you put in your draw schedule is the actual cost of the foundation, right? And it's accurate and supportable for the project itself. So once we look at that foundation and we see the foundation's been 50% completed or even 100% completed, at that point, we're going to reimburse you for that line item spent, right? So we don't necessarily need the invoice. The invoice helps, but it's not something that we're going to require up front. Right. Same thing for framing or really anything throughout the entire project. The only time you're really going to want an invoice is for your soft cost, as that's something that is really on paper. It's not actually work done.
For sure, yeah. As a builder or as an investor, I would always tell you, keep documentation on file. It's going to help you create a long-lasting relationship with the lender. It's going to help show your story of your experience. There's a bunch of different things that good documentation filing really helps with. And I know that most of you guys listening are investor builders, right? But sometimes be a filer as well, right? Work on your administration, because it really does help. But the fact that, you know, when you're taking your draws, you're not having to sift through all these invoices, paperwork to try and get a draw, I think is super helpful. But again, like I would say, for moving forward, it is super helpful to keep everything on file.
Yeah, I also think having invoices on file as a builder is super important, especially when you see a lot of the time nowadays where maybe a builder started a project in cash, right? They didn't have a lender partner, so maybe now they've stalled out, or maybe they've got another project that they want to start and they have used all their capital for one project specifically, right? We see it time and time again where we have to go in and verify the cost spent to date, and they don't have those invoices available, and it makes it very tough for us as a lender to verify what you've actually spent to date on the project to give you a correct value on the current property itself. So that's where I see invoices as super important, is something that is mid-construction or maybe has already been started so that we can verify what's actually been done and what's been paid.
For sure. And we want to give you credit for that as well, right? We don't want those cost spent to date funds to go into the abyss and, hey, we cannot actually verify those, so we're going to have to go off a lower cost basis, right? That's not what we want to do as a lender. We want to give you as much credit as has actually been done to the property and in terms of your cost basis, right? So keeping those invoices on file and having correct filings, super important. It gets overlooked a lot of times, especially when people maybe have gone from using their own capital, right, using their own cash on projects, to now wanting to scale and expand, and maybe not having the documentation on file that really helps them qualify for the top tier, better loans in a much smoother, faster process there.
Right. Couldn't agree more. All right, so let's touch a little bit on GCs, right? And what is the requirement, or how does somebody specifically qualify for a ground up construction loan? So tell me a little bit about kind of what you see and what Park Place requires specifically from a GC or a self-builder.
Yeah, for sure. So main thing is we want to see that they've completed at least 3 ground up constructions in the past 3 years. So 3-3, always your 3-3, that's your golden ticket to be a contractor and be qualified to build the project, right? And really what we're looking for is those builds can be on title, so them as an investor, or they can be for clients, right? We just need to really prove like for like experience in the ground up construction space, right? So when we're also talking about like for like, if a contractor's done 350k builds, maybe in McAllen, Texas, for example, and now they're getting contracted to build a 2.5 million, 6,000 square foot property in Austin, Texas, it's really 2 different builds, right? Yep. With the 3, we'd be able to verify that, yes, they can go from soup to nuts of a ground up construction. But it'd be really helpful if they would have like for like experience when going to do that higher construction build.
Yeah, when we say like for like, I think we're typically looking for a budget plus 30%, right? If you're in that range, then that's a like for like project. What we don't want to see is kind of like what Joe said, a $150,000 construction cost on one house, and then now you're bumping up to the $2 million category, right? It's a completely different ballgame, completely different style house. Cost of materials are way up, and the actual materials being used in the house are much more expensive or luxury than your past project, right? So that's what we're looking for on like for like. There's 3 main ways for a GC to provide that experience and verify the 3 builds completed, right? And I want to touch on that for a second. The main one and the most common one is a certificate of occupancy. What a certificate of occupancy is that's what the county or the city will issue you as either the owner or the builder, depending on what county you're in, for the property that is it's basically certifying that the property can now be occupied, correct, right? It is 100% completed. Everything's been done. All inspections have been approved and passed. That's the first one. It's the most common. But however, especially in Texas or other kind of certain cities or states, COOs maybe aren't issued, right? So the next one you're going to look at is a final permit. That's typically the easiest one to get because everywhere's going to give you a final permit. So we'll verify that all inspections have been approved and passed, and then we're going to get a copy of the final permit. And we just want to see the GC's name on the final permit. Correct, yeah. The last way for some states like Texas, right, where you can actually the owner themselves can pull the permit, so the GC's name probably isn't going to be listed on that final permit. What we'll do to verify that then is we'll go back into that and we'll get a GC contract. So we'll get a copy of the contract between the GC and the owner to verify that final permit matches, right? So that we're going to match the property addresses together. Correct. Those are the 3 ways we're going to document those 3 builds completed in the last 3 years. Correct.
Yeah, that's a great point. Documenting experience kind of goes back to the administration side, whether you're a developer or whether you're a general contractor. To gain more business from people that are actually using financing, super helpful to keep all your documents in check.
Yeah, and I think one thing to touch on too is what we've kind of said, as Joe mentioned, this is for somebody who's either been on title for the 3, right, and they have their own GC license, and maybe they built them for themselves to either sell or flip, sell or rent, or they were building them for somebody else. But one I want to touch on is a first-time builder, somebody who's never built one. Maybe they just obtained their GC license and now they're ready to get going. They don't have that experience yet, but they're looking to get it under the belt. That's where Park Place comes in, and we actually want to finance those builds for those builders because we want to do the first project. As we've mentioned in other episodes, we want to build that relationship, right? And we want to be kind of the stepping blocks for them. So what we look for on that side is they're just going to have to go get a signed contract with the GC who does have 3 completed in the last 3 years. Or maybe you've even done 1, right? And you don't have that 3 mark yet. You'll have to go find a GC who's done at least 3. And that's super easy. typically all we really obtain is a copy of their GC license, a GC contract signed between you and that GC, and then their liability policy, and that's really it.
And the key thing is that new GC that has the experience, do they or do they not have to sign on the loan?
With Park Place Finance, they do not have to sign on the loan, which is huge because it's really just a contract between you and them, which is verifying that they're completing the project for you as an individual. But for Park Place, we're not actually going to make them liable or sign on the loan.
Yeah, which is absolutely huge for people that are trying to get into the ground-up construction space.
Yeah.
So yeah, absolutely. That's a huge piece that Park Place Finance offers and should be utilized.
Yeah, and coming up next week, we're going to have a part 2 that's solely focused on first-time builders. So tune in for that. We're going to dive more into the details on that as well.
Yeah, absolutely. We're going to go over everything from documentation to how to qualify to how much skin in the game you may need as a first-time investor. So it really is going to give you the ins and outs of how to qualify for a ground-up construction loan as a first-time borrower. Some great markets that I know I personally fund a lot of loans in, and really the main things to look out for that are going to help your project be successful.
Yeah. So let's talk a little bit about kind of the challenges and pitfalls we've seen in the market currently for these types of ground-up construction deals.
Yeah, absolutely. When we're talking about challenges and pitfalls, we're not here to scare you away from doing those deals, right? It's really just an educational piece to be on the lookout for certain things, and it's just going to make your experience when you're actually doing these deals that much better. So I would really say the first challenge would be cost spiking, right? This comes back to budgets. We talked about it in our first episode on the fix and flips, right? Where people tend to under budget to make on paper the profitability of a deal look that much better, right? Maybe a little bit of an ego booster and, hey, I've got the best deal of the century, this is my spread, this is my net profit, right? I would go the other way. I would always go more conservative on what your budget numbers are and maybe even pad that budget a little bit to give you a little bit of room in terms of your contingency to deal with any spiking costs or anything that may cause delays, or maybe something costs more than was expected. Unfortunately, when you are budgeting, you can't really go through every single line item and make sure it's to the dollar, but you can get a really good rough estimate of what that's going to be. Now, what I would definitely suggest is get a contractor's bid from a experienced contractor, i.e. someone that's done 3 builds in the past 3 years. They're going to be able to give you a really good idea based on your plans, based on the square footage of the property, based on the market and the finishes and the specs of the home, what that property is going to cost.
Yeah, and I think one thing you touched on too is contingency. That's a huge piece that we see a lot of builders not put in their budgets. It's something that will only benefit you as a builder, right? Because again, these are non-Dutch loans. You're not paying any interest on the construction budget until you take a draw, right? So having 10,000 or 10%, whatever that is, whatever the number is, in the contingency line item, it's very important you have one in your budget because it will allow you to use it whenever you do maybe fall short or maybe cost you spike on a certain line item within the budget. You have that contingency built in to actually draw from, so it doesn't put yourself in a hole where you're now coming out of pocket on that line item specifically.
For sure. And that's the key thing, right? We don't want you to stall out. We even look for, as a lender, 10% in reserves of the total budget.
Yep.
It just double downs if we actually see that in your budget as well, to know that we are financing that. We would much prefer to do that than have that come out of the borrower's pocket if something comes up where costs are more expensive, and then maybe monthly payments could be jeopardized because they've had to actually spend those additional funds on the subject project there. So
yeah, I think the next biggest kind of challenge we see right now that's not accounted for when these builders or investors are obtaining these loans is the inspections and permitting timeline. So a lot of times you'll see builders come in with permits already in hand, and that's phenomenal, right? That means that the project's ready to go, everything's approved by the city, and they're ready to break ground and basically pour foundation immediately. Those are the best projects. What we do see, though, is, however, if you're purchasing land, right, maybe you're obtaining the construction loan when you're buying the land up front. That's something that you cannot get the permit at closing, right? You actually have to be the owner on title before you can obtain that permit. Where we see delays is maybe you don't have your full set of plans ready to go to be approved once you close on the property, or there's certain things that you're not ready for, or maybe you come in and say, I need a 12-month term, but your market is actually taking 6 months to issue a permit, right? If your market, for example, in somewhere in Florida, maybe is taking a little longer, 5 to 6 months to issue that permit, you're halfway through your loan term now, right?
Yeah.
That's not enough time to build the property, list the property, and sell the property, right? So that's a huge key piece. You need to understand your market. You need to understand the county that you're in, how long those permits and inspections are taking in order for your loan term and exit strategy to actually be sufficient and make sense, right? So that's a huge key piece for you to pay attention to prior to obtaining this loan.
Yeah, that's a great point, because without that permit, you can't do any work, right?
Yeah.
You can't be pouring the slab, you can't be starting on framing, so you are really delayed in your project by X amount of time until that permit's actually in hand, and then you're really catching up at that point. So know your city, know a rough idea of how long permits are going to take, right? And factor that into your timeline. If you need an 18-month term because of this issue, just ask your loan officer, right? They're going to help you out and they're going to get you the most suitable loan for your specific scenario. So
yeah, and we also as a lender understand those markets, right? We see it time and time again. So like we know what markets are typically taking longer to issue those permits versus markets that we know, like, hey, you can get a permit in 2 weeks the second you submit plans that are ready to go, right? So we do have a good understanding of that for our clients.
Yeah, absolutely.
I think that was it, right?
Yeah.
So sure. Oh, no, hold on, one more. And then the last kind of challenge I want to mention here is contractor reliability. We see it time and time again where a borrower hires a contractor that they didn't fully vet up front, and that's a huge important piece of the process, especially if you're not an owner builder, is getting a reliable GC, because we see it all the time where a GC will come in and maybe the GC's got too much under their belt and they'll just disappear. They'll flat out disappear from a borrower or an investor and not finish the project, which now basically stalls out the project completely. It puts the borrower in a bind and at risk of not only their project itself, but their loan, right? Because the loan is a short-term loan, as we've discussed, 12 to 24 months. They now have to go find a new GC, switch the permits over to the new GC. There's all sorts of things that come into place. So having a reliable, vetted GC at the time of closing your loan is very important. We as a lender are going to try to help you do that. That's why we verify that they have completed projects. We're going to do some background checks. We're going to look at a couple websites to see where they're at and what their projects are. You know, we can typically check and see if they have any other ongoing projects for you. Things like that we're trying to vet out, but you also have to do your own due diligence to make sure you have a GC who is reliable.
For sure, yeah. Can you just give a couple of quick tips on how to vet a GC potentially?
Yeah, so there's a website called BuildZoom. It's super important. You can typically see how many projects a builder has done. You can typically see if they even have any ongoing projects. Now, there's some markets that don't necessarily report to BuildZoom, so it's not always 100% accurate, but it does give you a good idea. The other way is I would ask a builder for a resume typically. I would want to see how many projects they've completed. If it were me and I was the one investing, I would typically ask them for their ongoing projects as well. So I have a good understanding of how many other builds do they have to complete in the next 12 to 24 months. I want to make sure that my project's being prioritized just like I'm prioritizing it. And then also vetting that experience allows me to understand that, hey, they have completed X amount of projects in X amount of time, so that I understand that they have the necessary resources to complete this build in 12 to 24 months.
For sure, yeah. And then I think a real quick, easy one that a lot of people overlook is just look at a website. Sometimes a website is going to give you all the information that you may need in a quick snapshot, right? It's not in detail, but usually a good contractor will have testimonials on their website. They're going to have previous projects on the website. They maybe have their license number. They'll be able to show what type of builds they've done in the past. That's just a real quick way to, vet a general contractor. Obviously, the website's not the be-all, end-all, but those ones that are truly professionals in what they do typically have a somewhat built-out website.
All right, and that about wraps up part 1 of our ground up construction loans. Part 2 is going to be coming out next week. It's going to prioritize our first time builders and then leverages Park Place Finance has to offer. Again, make sure to check out parkplacefinance.com and make sure to subscribe and like our videos.
That's all for the Loan Lads today. See you next time.